Yeah, so there's different ways to measure liquidity. There's global liquidity indicators, and then there's domestic liquidity indicators. And so here we can focus for a second on domestic liquidity indicators. And when you think of the way the fiat system works, there's different types of moneyness, right? There's bank reserves, there's broad money. Even T-bills can have a sense of moneyness. When you think of cash equivalents, a lot of people will put T-bills or money markets into those, even though those are technically short-term debt instruments rather than actual cash, right? So there's different types of these money-like assets, and the Fed and the Treasury basically adjust the ratio of how these compare to each other. If you have too much of one and too little of another, you can start to get basically like one of them squeezed out. And so back in 2018 and 2019, the Federal Reserve was performing quantitative tightening. So they were reducing their balance sheet. They were essentially selling treasuries. Now in practice, they were letting some of the treasuries mature and then not use the finances to rebuy them. So, but all intents and purposes, they're selling treasuries, which means they're basically destroying base money, and they're doing the opposite of money printing. They're destroying some base money on a gradual basis, and that's sucking liquidity out of the economy. And they were able to do that up until you had the September 2019 repo spike, and so that's basically this overnight lending rate that blew up. And a lot of people are like, oh yeah, like you point out, they were kind of obfuscating the issue. They were like, oh, it's a technical issue, don't worry about it. I was actually covering that pretty closely at the time. There was another analyst, Luke Groman, that made really good calls in 2019 about that becoming a problem. And then, when it started to play out, I was paying a very close attention to it. And my analysis at the time was that it was not really a repo problem. It was a T-bill oversupply problem, that the Federal Reserve was going to have to start buying T-bills again because they essentially had a supply-demand mismatch. And a lot of the T-bill purchases were happening, a lot of the Treasury purchases in general were happening from hedge funds using repo financing to buy those treasuries, right? So a problem in the repo market eventually cascades into the treasury market. And so my view was that they're going to have to start buying T-bills. And sure enough, a week later, the Fed says we have to start buying T-bills. And we're not going to call it QE, but we're printing money to buy T-bills, right? So the joke became that they're calling it not QE. And so it's like suddenly a repo problem is actually a T-bill problem. And for people that were kind of looking at that, it was not too surprising. And so that marked the end of their quantitative tightening, and then shifted back to a period of quantitative easing. And that was all pre-COVID, right? So when we got to March 2020, when we shut down the global economy in a large part, you had this, everybody's got in the whole world, they all owe dollars, right? So China lends out dollars, Europe lends out dollars, Japan lends out dollars to companies in Brazil, companies in Egypt, companies in everywhere. Everybody owes dollars. And if dollar cash flows dry up because trade stops, they still owe those dollars, right? And so there's like a dollar shortage. There's a debt squeeze. And what you see in that environment is the dollar spikes in value because all this debt represents demand for dollars. And they go to their central banks, and the central bank says, okay, well, we'll sell some of our reserves and we'll get dollars and we'll give you some dollars to bridge this gap. And so they rapidly sold their treasuries in March 2020, and that broke the treasury market, right? It just, it basically went no bid. You had people selling, nobody stepping in to buy. And so the Federal Reserve had to come in and buy $1 trillion worth of treasuries in 3 weeks. And so that became the story of 2020 and 2021, which was the Fed was creating new money, buying treasuries, basically financing government deficits, monetizing them. And in 2022, they're trying to go back to the same thing they were doing in 2018, 2019, which is that they're reducing their balance sheet again. They're no longer buying treasuries, at least on net. They're letting treasuries mature off their balance sheet. And so they're essentially sucking money out of the system and forcing the private sector to buy more of those treasuries. And we'll see how long they can go, but I suspect that much like 2018, 2019, they're eventually going to run into something breaking. I don't think it'll be repo market this time. If anything, there's the opposite problem, but I think it'll be just other areas. I think a lot of it's going to show up directly in the treasury market, treasury market illiquidity.
One of the differences over the past 3 years has been a major pivot by non-U.S., by global players, as particularly the BRICS plus countries in the East, of saying, and they've got lots of reasons why, but showing less and less appetite for buying treasury. So in the past, you might have looked to Japan or looked to the Bank of England or looked to somebody to come in and be your angel buyer. But do you expect that to be a missing piece? The cavalry's not coming anymore from overseas because of actions that we've taken.
Yeah, that's my base case, and that's actually even in the prior repo spike. So that whole 2018, 2019 period, once you had an inverted yield curve, you had no more really significant foreign buying. That contributed to the T-bill oversupply problem. And we have a similar problem here. There's one is that, whenever the dollar is on the stronger end, you generally have less foreign buying of treasuries. Basically, they're more like defending their currencies rather than, cheapening their currencies and accumulating reserves. That's number one. And then number two, because of the geopolitical issues around Russia, a number of countries have made also, some degree of strategic decision that, they might want to be careful about how much they hold in treasuries because the United States could essentially shut off their money. And that's a separate issue from what you think of the conflict, but it's just that basically when sovereign nations realize that their reserves are subject to, bank freezes, essentially, right? I mean, if you're in a jurisdiction where your bank account can be frozen, you might think twice about how much you want to put in the bank. You might want to have some money in some of your self-custody, physical cash, gold, Bitcoin, silver, whatever you want to do. You might think twice about how much you put in your bank account. Similarly, sovereign nations are maybe thinking twice about how much they want to hold in freezable assets, and they either want to diversify, right? So Russia says, okay, we're going to hold money in Chinese, assets to some extent, or you have other countries say we're going to own some gold and we're going to self-custody it because nobody can shut off the gold if we own it. And so there's a combination of diversification and other assets, self-custodial assets, as well as just the general trend that when you do have a strong dollar, you generally get less treasury buying in general.
So, what do you foresee likely happening in that area, and what would be the impacts that most people will observe when what you foresee takes place?
So I think in the coming years, we're going to see essentially a deterioration in quality of the treasury market. So we've already seen over the past year really bad liquidity conditions. So basically, that the treasury market's supposed to be one of the most liquid markets in the world. That if you're a billionaire, you can come in and buy or sell $1 billion of treasuries, and it doesn't matter. You don't affect the price because it's a deep liquid market. And what we saw over the past year, and to a greater extent over the past few years, but especially the past year, is how poor liquidity was. Right? There's not a lot of buyers and sellers relative to the size of the market, and so it's easy to move the price around. It's easier for auctions to be messy, where they start selling at one price, and by the end of the auction, they're selling at a different price because there just weren't enough buyers to keep buying at that initial price. And so my expectation is that treasury market liquidity is going to continue to be a problem as long as the Fed is not a buyer, because if you don't have foreign buyers, banks are no longer U.S. banks are no longer buying in aggregate. They were before, but they're not now. And there's only basically the buyers are things like pensions, wealth managers, households, family offices. You have these kind of domestic non-bank entities that are essentially buying what everyone else is either selling or not buying, and that can only go on for so long. There's only so much they can absorb relative to the size of their balance sheet, and then either you would have the Fed coming in back to provide more QE, essentially, kind of like what they did after the 2019 repo spike. Or another option that they can do is that they can adjust the supplementary leverage ratio for banks, which is a jargon for saying that they can change how banks calculate their leverage, but only for treasuries. It's a way of banks holding more treasuries, and it's functionally similar to QE, with the difference being that more of those end up on commercial bank balance sheets rather than the central bank balance sheets. So they have a couple levers they can pull if they run into liquidity problems, but all of those are generally pro-inflationary, and kind of generally would trend towards a weaker dollar rather than a stronger dollar.